Good morning, everyone. Time to put the minds in reverse because we like to buy high and sell low in fixed income markets. And I'd like to start off where Greg has left off. We really do live in interesting times in fixed income markets. Why? What is the biggest concern that our investors have told us is, I'm not making enough money or returns on my money market funds to sustain me. Why? And we ask why. And I always say, it's because the SARB has actually been naughty over the last 3 years. And what do I mean? Well, if you look at the chart, it's now exactly 3 years. Since September 2011, the SARB has been keeping official rates lower than inflation. So how do we make money out of money market funds? We've had high inflation. We've come through a bout of inflation. And yet we've seen the SARB only react with a slow progress of hiking rates. So this is a scenario that will probably continue for a while longer. And it's that whole idea of central banks forcing investors, what we call up the yield curve, to take more risk. There are opportunities, but we've also got to be careful of the duration element in going up the yield curve. We think there's opportunities in credit. So Greg has shown you how low credit spreads are in developed markets. They're not as low in South Africa. There's value. We think in certain corporates, in certain sectors, in certain company names, there's still value in credit. After the whole Able debacle, it's not an all fall down situation in credit markets. Not all credits are bad. So if we think about our credit process, and we're going to talk about Able, I think Able has been a quantum shift in a sense in the South African market, because for 10 years, basically since 10, 12 years in South Africa, since the bailout of Sambo in 2002, we've not had a default in the South African market. Now we've had our first default in 2014. And why is it significant? Because it affected about 75% of the fixed income collective investment scheme funds. When we look at our process, we'd like to take you through our process and say, why did a name like Able never make the hurdle rate for our credit investment process to make it onto our buy list? Right. Firstly, because if we think about our philosophy around credit, we say we want to buy credits in the South African market or globally with a very low probability of default. So we want our money back at the end of the maturity of the bond with a significant margin of safety. What is that margin of safety in fixed income markets? Spread. We don't want to overpay for fixed income assets in various markets. So just to give you an update of what's happening in the South African market, why did this situation happen? We've got to look at the demand and supply dynamics in the South African market. So let's start with the supply side. So the South African corporate bond market started in 2002, and it's grown significantly over the last 12 years. So how much credit is in the market? Well, we estimate around 100 to 130 billion every year gets issued in the South African market. Let's say this year we'll get about 100, 120 billion in the market. So who's buying the credit? Look what's happened, and these are Morningstar Stats. These are the three main categories of funds that will invest in credit. So your short-term funds, your typical, normal income type funds, your multi-asset income funds, typically where our diversified income fund will play, and then your low equity fund or your stable type funds. But look what's happened to the AUM, the massive growth. So this year alone, we think that 400 billion rands worth of AUM will chase 120 billion rands worth of credit issuance. Now we know that a lot of that AUM will also go into government bonds, but it shows you the AUM is nearly 4 times what the credit supply is. And we ask why credit spreads are low, exactly because of that reason. So why did we get this Able situation? The hunt for yield, 400 billion chasing 100 billion. And I think the one problem that we had was that that investors, and for a long time, this was the mindset in fixed income markets. You can just buy any credit as long as it's better than cash, because cash gives you a negative real return. If I can get a 1% or 1.5% more than cash, it's okay, because the default risk in South Africa is low. So what did the investors in Able paper do? Well, they obviously missed the whole default probability scenario, and also what we call the margin of safety, because they were willing to take a 2% extra yield above companies that were similarly rated, and we'll get to the ratings. But just to put it in perspective, remember when the Able situation started, it was still on a single A rating from Moody's International Rating Agency, right? So you can see what happened. You take 2% spread, and when we had that rundown in prices, and we saw this obviously from what happened to the Swiss bonds and what happened to the equity price. At one stage, before the SAR bailout, those bonds were trading around 40 cents in the rand. You would have lost 60% of your capital for taking 2% extra yield. Now, in fixed income markets, is that really worth it? Because that was really the situation. So I know there's investors that's now crying and saying, but why did the SARB only give us 90% of our money back, and there was side pocketing? But if the SARB did not bail you out to the 90, you would have got only 40 cents in the rand back. So the SARB actually did a good thing in a sense. But you can see what we call the asymmetry. 2% extra yield, you can lose 60% of capital, because unfortunately a credit market is a very binary market. It's a bit of an all or nothing situation. So you've got to be very careful, and we've got to make sure that we get the probability of default right, and second, we've got to get the margin of safety right. So when we look at our credit process, and let's start with what we call a probability of default. So when we look at Able, and remember this is for all our credits, we put every single credit that's on our buy list will go through this process. Moat. What was the sustainability of cash flows? Now, it was always a concern to us that the Able business model would be very challenged. Remember, Able had about 45 billion rand of debt in the global markets, of which 30 billion was in South Africa. We always thought that it's going to be a challenge to be able to service that amount of debt. We also knew that they weren't at the top of the pile when they were granting loans to indebted consumers. So we were worried about the moat and the sustainability of the cash flows. So that was a negative for us there. When we looked at their management and we compared them to other names in a similar industry, we said, well, we're concerned around the provisioning that Able. Do they have enough provisioning on their balance sheet against the amount of loans that could go bad? So that was a very big concern for us. And on our margin of safety, we said, we wonder if there's enough free cash flow and asset generation on their book to give us our money back. And we've obviously seen it's not possible. Because as debt investors, at the end of the day, what do we want? We want our coupon every quarter or every 6 months. And at the end of the maturity of the bond, we want our money back. That's how fixed income works. So on a big scale, Able did not tick the box for a probability of default, right? The second was the rating, and we'll get to the rating. As I said, Able was single A rated right into the whole debacle. Only 2 days after the SAR bailed out Able, was it downgraded 6 notches from A to CCC by Moody's. So can we rely on rating agencies? No, we can't, because it feels like 2008 again. What happened in the subprime crisis? There were AAA rated securities in all sorts of structures in the US that wasn't AAA. And only after the fact it was said, oh, we made a mistake, because they were also probably CCC and below. We cannot outsource our DT2 rating. So what do? We generate our own rating at PSG AM, right? You don't have to read this, but what I want to what I wanted to get to is we generate our own rating. So in this whole debacle with Able, what happened? The 4 major banks were downgraded, and Capitec was downgraded 2 notches. And we had to say to ourselves, but is that right? does Capitec deserve to be downgraded 2 notches? And we really tested our whole theory, and we stressed our model, and we said, no, we think that Moody's is wrong. We still think that Capitec is a single A-rated quality company, and we still feel that the probability of default is low. So it's quite clear that we have to do a lot of our own work and not just rely on rating agencies. So a final word on credit. There's still good quality names in credit markets, but they are going to be challenged. I'll give you a good example. Standard Bank came to the market yesterday. They wanted to issue 3 billion rand of debt. They only got about 2 billion rand of it away, and probably at a spread, which doesn't seem a lot, but probably about 10 to 15 basis points higher than where they thought it would be. So that's what's happened to credit markets. It doesn't say that Standard Bank is now a lesser quality credit, but what it does do is it gives us more margin of safety. We can say, well, you know, a year or two ago, Standard Bank was happy to issue 3-year debt at around 90 basis points over the govies. Now they have to issue at more than 1% over. But it's still a good quality name. Standard Bank is still a good quality name. We can just buy those names with what we call better margin of safety, so we can add more value to the portfolio. And we'll still search for good names. The Bidvests, the Imperials of the world are still issuing. We will just buy them with larger margins of safety, which will give us that opportunity to give our clients a better real return in our fixed income portfolios. Right, so looking at valuations, now that we've talked around credit, what's happening in fixed income markets? So let's start where the SARB starts, with the Taylor rule. What is a Taylor rule? Taylor rule says, where should short-term interest rates be given the current growth and inflation trajectory? So at the moment, it looks like, because growth is so low in South Africa, that rates are probably where they should be. But if we put our own fair value model in, and we think where global rates will be in a year's time or so, we say, well, we think there's a range, and we think that fair value, so if we think that inflation in South Africa averages 6% over the long term, and we should have some sort of real return from short rates in South Africa. Why? Why does the rand blow out? Because we run with those negative short rates while we're running a current account deficit as well as a budget deficit, which is not sustainable. And that's why we get the sell-offs in the rand, and then we get an inflation spike after it. So we say, if inflation in South Africa is 6%, at least the SARB should run with at least a 0.5% real rate to try and just put some stability in the rand because of all the deficits that we have. We think that the repo rate should be around 6.5%, 7% over the next year. So we can expect that over the next year, the SARB will probably at least have to increase rates by another 75 basis points to 1%. What does the market say? Market is still looking for hikes. Still lots of tables. All I want to say to you is that the curve is still upward sloping, meaning that the market is still looking for rate increases. We're not at the point where rates have topped out yet. We're not at the point where the SARB will be cutting rates, because we're going probably into an environment where global rates, especially in the US, could slowly start to be raised. I think most market participants are looking for the Fed to start with some sort of normalization action in the latter part of 2015. So where do we find value? So what do we do? We'll get into bonds. So we say inflation is 6, and it's going to be 6, between 5.5 and 6, let's say, over the next year. We're finding value in cash. So we say, well, there's a low durational risk in cash. Inflation is 6. We can give you around, call it 7.30 on 1-year CDs. That's more than CPI plus 1 at a very low risk level. That looks attractive to us. So why don't we buy bonds? Because if we look at our fair value of bonds, the market says to you, don't worry too much around the calculation. What I want to get you to is, the market says the fair value on the South African 10-year bond is 9%. But where is it trading? It's trading at 8, with a duration of, let's say, 5. So when bonds move from 8 to 9, with a duration of 5, we'll lose 5% on capital on 10-year bonds, taking that risk. And you're not even far away. So why would you buy a bond with a 5 duration below 8 and a 1-year CD is sitting at 730? So that asymmetry is not a line for us at the moment. We'd rather be in 1-year CDs than 10-year bonds. So why don't we buy inflation-linked bonds? Very similar scenario, because our fair value says, well, we think that fair value on inflation-linked bonds is probably anywhere from 2.5% to 3.5%, yet they're trading below 2%. Doesn't make sense. We think it's a very, very expensive asset class. The second problem you have with this market, it's very liquid. So if you get this trade wrong and inflation in the world goes up, it can be a very, very painful trade. If we say to you that nominal bonds has got a capital sensitivity or duration of 5, when we talk to inflation-linked bonds, we're talking about a capital sensitivity of 11 with very low liquidity. So when you buy inflation-linked bonds, you want to buy them at the correct real yield, which is around 2.5% to 3%, and you want to buy and hold them over the long term. You don't want to trade in inflation-linked bonds. So how are we positioned? Knowing that inflation is 6, cash is at 7, long bond yields are around 8%, and inflation linkers are sub 2. We are conservatively positioned. So if we look at our asset allocation, we say, well, we've got a lot of floating rate notes because we are still in a rate hike environment, and rates will still go up over the next 12 to 15 months. So we want to protect our investors against a rate hiking cycle, firstly. We want to be, So something like our income fund has got a very high percentage of floating rate notes. We want to outperform cash. We want to give you a real yield above inflation. In our diversified income fund, we've got our 8%, as you've seen, in equities, 4% offshore, 3.5% onshore. The component of fixed that you see is typically the NCDs, very, very conservatively positioned in our portfolios. Why? And this is a story. So if we think that inflation over the long term is going to be 6, you barely make inflation on your money market fund. So why not move to an income fund or diversified income fund where you've got this 1 to 1.5% pickup over money market funds, but you're not moving on the risk curve, and I think that's quite powerful. So where do you sit on the risk curve? So we say, well, we're basically sitting where money market duration risk is. We're getting a nice high yield. For less than 1% to go to 8% to bonds, you'll take 6 times more interest rate risk, or to get that same 8% from inflation bonds, you'll take 11 times more risk. Does not make sense to us. The asymmetry does not make sense to us. We think there's a good opportunity to be in income space or diversified income space versus cash, especially in an environment where the SARB will start normalizing rates over the next 12 to 15 months. Okay. Thank you. I'll hand back to Greg to finish off. Thank you.